As we stand here, about 10 years into the longest bull market in history, it's sometimes easy to confuse genius with a strong market. It would have been pretty difficult to not enjoy positive returns over the last 10-year period. But as some signs emerge that the booming economy may be slowing, now may not be a bad time to understand the amount of risk you're taking in your portfolio and to contemplate whether or not it's the right amount of risk for you. Risk is a pretty vague term, but is most commonly measured by a financial metric called standard deviation, or basically how much your portfolio moves historically, good or bad. The decision of how much risk you should be taking shouldn't be arrived at generically. It should be taking into consideration the things that are going on in your life, your personal risk tolerance, and your circumstances. Things that you should consider when evaluating the right risk for you. Number one is your personal risk tolerance, or how much you can tolerate the bumps in the road. And number two, your spending plan. So when that money is going to be used in your life. Shorter means that you should be less aggressive. Longer term money, you could weather markets a little bit better and could tolerate more risk. Things that you should generally not consider when deciding how much risk to take. Number one is what you, your friends, or experts might consider the market to do next. Nobody really has a crystal ball. And the second thing is racing to try to take more risk because you feel like you're behind and you need some growth to get you to your spot. Sometimes that can have the exact opposite effect, and you could find yourself overly exposed at the wrong time and actually have to put your retirement plans on hold as a result. With the emergence of tools, financial planners now more than ever can gather a lot of information and help you identify what your risk tolerance is, both as an individual and as a household. If you're unsure if you're taking the right amount of risk, now may not be a bad time to have a checkup.
The Cautious Investor with Jonathan Lapine is sponsored by W3 Wealth Management.